Hello ladies and gentlemen, welcome back to C.A.R. Entertainment. I'm your host Dylan Hamilton, and today guys we're going to be doing our final video of A21 Business Studies, and it is going to be on investment appraisal. So investment appraisal involves two forms of actually appraising different forms of investment, and that is using payback and net present value, and we'll actually go through and talk about them now. So the reasons you'll carry out investment appraisals to start off with is that it will enable a project to be evaluated, so you'll be able to look at your projects and see if you should do them or not. You can also compare company projects, so if you have two projects you can see which one might be better, and then you can make a decision which is based on financial criteria. The problems that arise with forecasting cash flow is that the validity of the future cash flow figures can be in question, and also with the interpretation of the figures, and investment appraisal also doesn't consider all the aspects of the business, so that may be a problem when forecasting cash flow as well. So if we go on and we talk about payback, which is the time it takes for an investment to repay the initial outlay, you calculate this by using your income acquired divided by the contribution per month, but you do this in a way that's a wee bit different. So let's say the business is investing £50,000 and then they're going to make 10,000, 20,000 and 30,000 and then 40,000 in so many years. So 10,000 year one, 20 grand year two, 30 grand year three, 40 grand year four. They're going to have paid that back in year three because it's 50 grand investment. So 10 grand year one, still haven't paid it back. 20 grand year two, so that's 30 grand in total, still haven't paid it back. 30 grand year three, that's 60 grand in total, you've paid it back. So at some point in year three, you've paid it back. So what you need to do is you need to think, what have I made at the end of year three? So in total, 30 plus 20 is 50, plus your 10 is 60 grand. You do your 60, take away your 10 to find the difference. You have 10 grand, you get 10 grand, you divide it by 12 for the 12 months in that year three. Whatever number you get is how many months. So you can say it's 3 years and this amount of months. And that's how you can tell what your payback is. The advantages is that it's easy to understand, it's simple to use, and it's good for screening projects, but the disadvantages is that it doesn't take into account any cash flow after the payback period. So once you've paid back, well, it doesn't take into account how much money the actual machine or whatever it is project you're making, and then the overall profitability of the investment is not considered yet, so it doesn't tell you how much money it's going to make. It also doesn't consider the current value of the cash as well, so it doesn't tell you the value of the machine, free depreciation, etc. And this is where net present value come in, because it does take into account the time value of money. So sums will be discounted or reduced by a certain percentage to reflect the lower value. So you'll be given a depreciation rate, and you'll apply this to every year as you go through. The advantages with using net present value is that it's a lot more realistic because it will consider the time value of money and it will consider various scenarios. But it does have its limitations as well, such as that it's quite complex to calculate. The results can be easy to misread, and the discount rate that is used is very critical in terms of actually calculating it. So the factors that will influence investment decisions include such as things like capital, what the capital that's available, your opportunity cost, the technology you use, the risks involved, and some qualitative and quantitative factors as well. So that's it, guys. That's our spec over and done with A21 Business Studies. I hope you've enjoyed going through all these videos with myself, Dylan. And yeah, we C.A.R. Entertainment wish you the best of luck in your exam. I've been Dylan Hamilton from C.A.R. Entertainment, and I will see you next time.